everybody. Thank you so much for joining us today. My name is Sam. I'm in client services here at the Retirement Group, and I am going to be moderating this webinar. You'll see me throw some valuable resources into the chat throughout the presentation. They will direct you to our AT&T retirement guide, as well as a full library of all of our past AT&T recordings, and a link to book an appointment with an advisor after this webinar. Today's webinar will be focused on the various factors you must consider when deciding whether to take the annuity or lump sum option upon retiring from AT&T. I will be bringing our speaker, Tyson Mavar, on shortly to discuss this all at length with you and provide some very valuable insight. But before I do that, I must remind you that although the Retirement Group works very closely with both active and retired members of AT&T, we are not affiliated nor endorsed by AT&T. I'd also like to let you know that after Tyson's presentation, we will be hosting a short question and answer. So if you find that you have a question while Tyson is speaking, feel free to put it in the Q&A box, and Tyson will answer as many as he can, time provided. And with that, I think I'm just going to introduce you to Tyson Mavar. Tyson.
Thank you, Sam. And thank you, folks, for attending our webinar series today. My name is Tyson Mavar, one of the AT&T focused retirement advisors for the Retirement Group. We appreciate your attention this afternoon. Today, we're going to be talking about the AT&T pension, specifically one of the biggest decisions that our clients from AT&T have to make when they retire from the company, which is how to take their pension, whether as a lump sum or one of the various annuity options. We're going to go through some of the important considerations today. For those of you who aren't as familiar with our company, the Retirement Group is an independent financial planning organization that focuses on helping corporate employees maximize their benefits, transition successfully into retirement, and we also manage retirement assets for retired employees of AT&T and some other Fortune 100 companies around the United States. And we've been doing so for just over 30 years, since the early 90s. We have a variety of advisors throughout the country, and our hope is that at the very least we can educate you on some issues that we've seen with people transitioning from AT&T over the last several decades, so that you can make sure that you have the most comfortable retirement possible and feel confident that there was not any information that you did not consider, so that you have the best retirement possible when leaving AT&T. We have a whole host of complimentary services we recommend you take advantage of if you haven't done so already. The retirement cash flow analysis is where most people find the most value in understanding where you stand and what items you may want to consider prior to transitioning from AT&T. Again, that's a complimentary service. If it's been a while since we've updated yours, let us know, and we're happy to update it with the new interest rates that affect the pension and some of the recent tax law changes that affect retirement accounts. And if you've never done one of these, I strongly encourage you to take advantage. All we ask is, if you do find value in this exercise, that you help us to grow our business by referring us to some of your other coworkers at AT&T so we can continue to grow our business. Now, the AT&T pension plan, there are many different plans at AT&T with all of the mergers and acquisitions that the company has gone through over the last several decades. But what is consistent among all of these plans is that the full retirement age at AT&T, as far as the pension is concerned, is age 65. All benefits will be based off of an age 65 single life annuity. And the company will take things like your life expectancy, maybe your spouse's life expectancy, your age typically when you leave the company, and interest rates to convert this monthly annuity into various other options. For instance, the lump sum, or what many employees have, not all, but many, is a joint and survivor annuity. We'll talk about all these different benefit options in a moment. Now, this benefit is designed as a traditional pension plan to pay you a monthly payment for the rest of your life. But not everybody is eager to take that annuity option from AT&T, and many people, in our experience, have opted to take a lump sum. So we'll talk about the benefits, potential benefits, and then also the potential detriments of the lump sum and the annuity. Now, if you retire prior to age 65, there could be some discounts, although I will tell you that most people that we work with are on a non-bargain program from AT&T. and you no longer have age penalties after age 55 on this plan for many people, not everyone, but many. So you don't necessarily have to work until 65 to get a full pension payout, but this is still what they call the normal retirement age. And for many of the plans, if you retire after age 65, you will not have flexibility in deferring your pension, which you might otherwise choose to do if you retire prior to 65. For instance, we'll show the interest rates that ended the year last year in November that are in effect for anybody who retires this year. And those interest rates have actually gone down since November. So if you're somebody who's approaching the end of the year and you predict that interest rates will be lower next year, this might be an indication, or it might be an incentive for you to defer electing your pension if you are qualified to do so in order to get a larger lump sum payout, knowing that rates will be lower in the future. This is just one instance that you might consider deferring a pension election, but you might not have the ability to if you retire after age 65. Here are the common pension distribution options. Not everybody gets a lump sum at AT&T, and not every plan has a joint and survivor annuity option available, but most of them have all three of these benefit options: a single life annuity, a joint survivor annuity, and a lump sum option. We'll also talk a little bit about the interest rates that affect the lump sum today. So the single life annuity, and this is the default payment option. It's the option which all other benefit options are based off of. It's one where AT&T will pay you, the retiree, a monthly benefit for the rest of your life, no matter how long you live. Now that is a fixed payment amount. It's not adjusted for cost of living changes over time. And one of the many risks and concerns that we hear from people that do end up taking a lump sum is the fixed nature of this payment, or lack of ability to keep up with inflation over time. Certainly something that we've been even more concerned about recently here in the United States. But this is a benefit option, very common for unmarried individuals, in my experience working with folks from AT&T, who are not as concerned with death benefit flexibility, which the lump sum offers. For those folks that maybe don't have beneficiaries that they're very concerned with, or in some cases, those folks that anticipate a very long life, those are some of the benefits or some of the reasons we see people choosing to take this option: longevity and lack of concern for beneficiaries, at least in my experience. The joint survivor annuity, on the other hand, is a lifetime payment for two individuals. And this is typical for married individuals, but not always for married individuals, to choose a joint survivor. Could be a husband or a wife or a spouse, a partner. This is going to be a lifetime payment for 2 lifetimes. And as a result, it's going to amount to a lower payout. In other words, you're having to essentially pay money to the company by giving up some monthly income in an effort to cover 2 individuals as opposed to 1. And the reason for this is because the life expectancy of 2 individuals is, of course, longer than 1 individual. There are a variety of different types of joint survivor annuities. Most people will have an option to take a 100% joint survivor annuity or a 50% joint survivor annuity. What that means on the 100% joint survivor, there is going to be no reduction of income after you, the retiree, passes away. Your spouse or your joint annuitant will be collecting the exact same amount, or 100% of you, what you were during your lifetime. The detriment, however, is that that amount will be much lower than if you were to otherwise give your joint survivor a 50% annuity option, which of course would be half of what you were collecting during your lifetime, but allowing you to collect more prior to your death or after retirement, while you and your spouse, in most cases, were together, having a larger payout option. So typically that's more common, although I will say we have many clients that have a spouse who doesn't have a pension of his or her own and may not have any retirement benefits. And in my experience, I've seen those people more inclined to take a larger payout option to make for a lesser reduction upon their demise or upon their death. So you could see there's a lot of variables here that we would prefer to evaluate in our cash flow analysis. Get to know you, whether or not you're a client. If we're running this retirement analysis, we want to give you our best opinion based on all of your circumstances, what we've seen work out well in the past of the people that we've worked with who are retiring from AT&T. Now, when it comes to the lump sum, the company not only is going to use your life expectancy at retirement, also known as your age, but interest rates. And the interest rates they use are based on short, intermediate, and long-term corporate bond interest rates. They're also based off of the November interest rates that are published by the IRS every year. Now, the IRS publishes these rates monthly, so we track these rates throughout the year leading up to November so that we can give good advice to our folks how much they're likely to lose or gain on their lump sum should they defer their retirement into the next year or even defer the election of their pension, but not necessarily their retirement into the next year. The interest rates have a pretty substantial relationship with the lump sum. You can see here, we're showing the November 2022 interest rates. There's 3 of them. And we also show right below that how much those interest rates jumped in 1 year compared to the November rates of 2021 in this case. And as it turns out, it's the second segment rate, the middle column here, that carries the most weight in the calculation. This interest rate went up 2.88% in 1 year, which is the largest increase in interest rates that we've seen in over 30 years, which means that a lot of people lost a lot of money on their lump sum if they did not retire and take their pension prior to the end of last year. So you probably saw some of your coworkers leaving if you yourself are not retired yet. If you did retire, hopefully, if you were taking a lump sum, you were aware of this and may have been making a decision based off of this. In plain English, what this means, it's typically a 10% reduction in your lump sum for every 1% increase to these interest rates. And now that's not exact for everybody. It's also a factor of your age. Somebody who's younger is going to have an even more substantial reduction in their lump sum for every 1% increase to interest rates. And we were seeing on average, people were losing around, in some cases, more than 30% on their lump sum overnight when AT&T updated these interest rates on January 1st. So it's definitely worth your time to understand how these rates work. They don't affect every pension. They don't affect the cash balance pension plans the same as they affect the defined benefit pension plans, non-bargain, ALM, the Southwest program, or the union pensions around the country. They all work a little bit different. This is why we understand as advisors of AT&T employees each one of these pension plans so as to be able to give good advice to our clients from AT&T. And we encourage you to work, whether it's with us or somebody else, with somebody that understands these really important issues that affect the benefits, so you don't leave any money on the table when you leave AT&T, whether that's soon or maybe not so soon. So stay tuned. We'll be updating folks on the interest rates as we approach the end of the year. I mentioned earlier, these rates have come down a little bit. And if that continues, that may be a reason to defer the election of the lump sum for those of you that are retiring this year, whether it's by your choice or by force. You want to be aware of this, and it might make some sense to wait to take your pension until a few months after you leave the company because of what these interest rates do to the lump sum. Now, why would people take a lump sum if you could just take annuity from the company, where the company has to pay you based on ERISA laws, and of course, based on the full faith and credit of the company? There's been companies that we've seen in the past go out of business, which shifts things a little bit in terms of who's responsible for paying this monthly payment for the rest of your life. But there's a variety of reasons people will take a lump sum. In the recent years, lump sum payouts were very high because interest rates were historically very low, and this attracted a lot of people who, many of them were anticipating interest rates would go up eventually, and they could go invest that money at a higher rate than was assumed when that lump sum benefit was calculated in that low interest rate environment. As interest rates have gone up, those lump sums have gone down. The silver lining on that, however, is that now you can invest that money at a higher rate. So you may still be able to produce the same amount of income in retirement, even with a lower lump sum, given what fixed income investments, things like bonds, investments that are less volatile than stocks, are going to be able to pay you throughout your retirement. There is no guarantee, of course, that those interest rates won't change in the future. And of course, there's no guarantee with what your stocks and other assets in your retirement portfolio are going to generate in terms of returns. So it becomes, the onus is on you now in retirement if you take this lump sum to invest this wisely. This is also why most people that we've experienced from AT&T who take a lump sum typically hire a financial advisory firm like ours or some of our peers in the industry to help them protect this money, invest this wisely so that it's lasting at least as long as they do, so that they're not running out of money by spending this money too quickly or not earning a rate of return that is sufficient to at least keep up with inflation and have this money last at least until a normal, if not a long life expectancy. Of course, you'll have other assets that will help you fight inflation or hedge against inflation. Hopefully you saved well in the 401k that you can invest that and distribute that at will. But the lump sum becomes similar to like your 401k if you decide to take that option, in that you're responsible for not overspending that money, you're responsible for investing that money, and you also have the ability now to pass that money to family members or causes that are important to you if you don't spend it all throughout retirement. Now, we often hear from many folks that it seems counterintuitive that when interest rates go up, that their lump sum will go down. And the reason, it comes back to a present value calculation of future cash flows. Think of this as a mortgage. Think of your lump sum as the amount of money that a bank will lend you for a house if you borrow money on a mortgage. So let's assume that you have a fixed budget of $1,950 per month to buy a home, to pay for a mortgage. And let's say at first you go to the bank and interest rates are at 4%, and the bank says, well, we'll give you a 30-year fixed mortgage and we're willing to lend you $408,000, $408,500 at 4% interest rates. Well, let's say you go back a couple months later and now interest rates have dropped to 3%. So interest rates have dropped. Nothing has changed to the amount of budget you have on a monthly basis for your home. But because interest rates have dropped, what has happened to the amount of money the bank is willing to lend to you is that it has gone up. And in this case, it's gone up to $462,500. The opposite would also be true. If interest rates, we saw this recently, interest rates went up, so the value of homes that folks could afford that were on a fixed budget has actually gone down as a result of interest rates going up. Same reason your lump sum goes down when interest rates go up, and your lump sum will go up when interest rates go down. It has to do with time value of money and a present value calculation of future income streams. And something else I'll add to this is if the company is creating a pension payment in the form of an annuity and you get older, in other words, your life expectancy is shrinking as you get older, the company expects to pay you fewer annuity payments, given that you are expected not to live as many years after you retire, if you retire later in life. As a result of that, the company also will reduce your lump sum as you get older. So if nothing changes other than your life expectancy is shrinking, your lump sum is also going to be going down. And that's in many cases why it does not make sense to defer the election of your lump sum beyond your retirement date. There's some exceptions to that rule, but the longer you wait to take the lump sum, typically the less money the company has to give you as a lump sum. The big two exceptions, of course, are if interest rates go down, your lump sum goes up, or if you still have age penalties, there could be a reason to defer the election of your pension to get more money. But typically your age is working against you when it comes to the lump sum. And a reason, even while people are still working, in some cases we see people's lump sum going down if interest rates are unchanged, even though the company's still crediting their pension on most of these pension plans, you could also see your lump sum go negative even while you're still working at the company. And some considerations for retiring maybe earlier than you expected as a result of this phenomenon as well. Now, unfortunately, statistically, what we've seen is that 74% of Americans over the age of 50 do not have a written plan for their retirement. We see this as absolutely unacceptable, given there are a variety of companies, including ours, the retirement group, that are willing to do this on a complimentary basis for you in an effort to get to know you and an effort to allow you to get to know them, so as to hopefully have an opportunity to earn your business at some point in the future, should you choose to work with an advisory firm. Take advantage of this, folks. We're happy to do it for you on a complimentary basis. The only cost to you is, of course, some of your time in giving us the inputs that we need to run the numbers. And then, of course, setting up either an in-person or a web meeting to review the results of the plan. And in doing so, typically we can uncover some areas where you might want to consider changing things that you're doing, whether it's changing how you're saving into your 401k plan, the amount that you're saving, whether it's pre-tax, after-tax, or Roth contributions to your 401k, how you're invested in the 401k, which option you might want to consider on taking your pension, the timing of your retirement we found is the biggest mistake people make, choosing the wrong day to retire. And oftentimes that doesn't mean retiring too soon. In some cases, it means leaving too late. And this is an example we saw last year when folks' retirement plans, total assets had major reductions if they did not leave payroll. Not to say that was the right choice for everybody to leave payroll last year, but it was the right choice for some, and many people left in an effort to avoid lump sum losses on their pension. So spend some time with us, folks. We're delighted to spend some time with you. If you're willing to spend a few minutes with us, share some of your personal financial information with us. We're very confident that you'll find that to be a good investment of your time. Just let us know how we can help. If you'd like to have a one-on-one conversation with us or just ask some specific questions, you can email us at info@theretirementgroup.com. You can call us at our home office at 800-900-5867. You can even take a picture of this QR code to get onto mine or one of our advisors' calendars to talk about your own situation. And here's a QR code for our LinkedIn page where we publish these webinars so that you could peruse the topics that are of most interest to you at your own leisure. So with that, we're going to open it up for questions. And Sam, I'll let you read off any questions that we had from the folks on the webinar.
Thanks, Tyson. We did have several questions come in. First one, how do the taxation implications of a lump sum pension payout differ from an annuity pension payout?
Good question. Potentially not at all. They use the same tax tables for withdrawing money from a lump sum, whether you rolled it over to an IRA or possibly to your 401k. When you withdraw that money, it's considered ordinary income, not to be confused with earned income. Although they use the same tax brackets, this is going to be the same tax rates as your annuity. However, many of you know that in the progressive tax system that we live in here in the United States, the more income you have in a given year, the higher your tax bracket goes. So if you were to, let's say, have AT&T make your lump sum pension check payable to you, devastating mistake that we have seen happen in the past, that will be taxed in many cases in the highest tax bracket possible, 37% currently. Whereas if you roll that over to an IRA, a 401k, or an appropriate qualified plan, you could continue to defer taxes until you withdraw money from that plan. So if you were creating the same income stream as your annuity would have allowed for, let's say the annuity was supposed to pay you $3,000 a month before taxes, you could create the same one with a lump sum just by making withdrawals from an IRA. But if you're like many people that we've worked with in the past, you may want to pay off your house or pay off student loans or go buy something that costs some money. Oftentimes we encourage our clients to structure this in a way that it doesn't push them into a higher tax bracket, and you can manage your tax bracket better throughout retirement so as to minimize the amount of money you give up to the federal government, in some cases state governments, depending on what state you're living in retirement. So it could be the same. This is also a reason we've actually seen some people attracted to the lump sum just so that they can continue deferring income on their pension. For instance, if you leave AT&T and go to work somewhere else, you may not want taxable income that the annuity would force upon you, whereas the lump sum, you could roll that over and continue deferring income and taxes until you actually do need the money once you do retire for good. So there are some considerations there, but same tax brackets, assuming your income is the same, regardless of whether you take the lump sum or the annuity.
Wow. Okay. Second question, what are the key factors I should consider when deciding between a lump sum pension payout and an annuity pension payout?
Yeah, great question. So probably the biggest decision that we come across folks having to make when they retire, how to take this pension. It's irrevocable. You can't change your mind on how to take it once you've taken that option. So put some thought into it. Here are some of the best benefits that I've heard from people why they're attracted to both options. So let's start with the annuity option. Some sense of certainty in how much income you're going to have regardless of how long you live. AT&T is on the hook to pay you this money as long as you're alive and as long as they are not in some kind of a bankruptcy situation, in which case the liability would shift over to an organization called the PBGC, the Pension Benefit Guarantee Corporation. So that feeling of certainty on the paychecks in retirement, that's a check in the annuity column, I would say, as an advantage for some. Longevity risk, AT&T pension plans help to reduce longevity risk, or the risk of you living a long time, because you'll always have some money coming from AT&T, assuming AT&T is around as long as you are as a business. We also have some people just not wanting to make decisions of how to invest this money. I'll tell you, if you don't like talking to financial advisors regularly, that might be a reason to consider the annuity, because there's just less decisions involved. They have the company responsible for paying your paycheck and not reliant on investments, putting together a portfolio that's going to protect and grow your money over time. Now, the lump sum we've seen as be very popular, especially in the last few years. I've been with this company since 2011, and interest rates got lower and lower throughout this last decade or so. And I will, from my own experience, say that the lump sum got more and more popular as the amounts got bigger as a result of falling interest rates. The other reasons that I would say people take a lump sum more often than the annuity is flexibility to spend the money as you need it. You might want to spend more money in the early years of retirement because you're younger, have more energy, you're getting around better. You have these bucket list items that you want to be checking off your list, fixing your house up, moving. There's all sorts of reasons people might consider spending more money in the early years of retirement and less money later. But certainly risks of overspending in those years. And one of the reasons we run a cash flow analysis to avoid overspending and maintaining a sustainable plan. But there's a lot of flexibility there with the lump sum. Also flexibility on how to invest the money. I have many clients that are fairly confident that they can create a better income stream with their investment performance. And some of those people manage their investments on their own. Some of those people hire a financial advisor because they realize the stakes are very high when it comes to retirement. If it doesn't work out, it's going to be very difficult to go back and work another 20 or 30-year career. So getting it right the first time is critical. And so if somebody is, let's say, having a lower risk tolerance, the lump sum might not be as appropriate compared to somebody with a higher risk tolerance and willingness to continue to be investing in stocks. That lump sum might be more attractive to that person. Somebody who's concerned with inflation had this a lot more, talked about a lot more in the last couple of years, be a reason to take the lump sum, because you can invest the lump sum and fight inflation through growth on your investments, whereas the annuity, as we talked about earlier, does not increase over time with cost of living increases. So as the cost of everything we buy in retirement gets more expensive, the value of that monthly fixed income from AT&T gets less valuable. Inflation, a big one. And then last but not least, in fact, probably one of the more common reasons I see people interested in taking the lump sum is because there's somebody, whether it's a spouse, children, grandchildren, a cause that's important to them. There's somebody that they would like to leave the money to other than AT&T if they don't spend it all. Whereas if you take the annuity and you only live 5 years into retirement, you would not have received nearly as much money, or I should say your family would not have received nearly as much money in that option compared to if you had taken the lump sum. So there's a whole host of reasons that we've heard people considering the lump sum and attracted more to the lump sum than the annuity, but it's not right for everybody. And we've seen a lot of people take the annuity just for the certainty and the lack of decision-making that comes with taking that option on the pension.
All right. Third question. How do annuity pension payouts impact my Social Security benefits?
Great question. We talked a little bit earlier about earned income versus ordinary income. Earned income is what you're earning from AT&T, or if you go to work somewhere else after AT&T, that's considered earned income, and it could potentially affect your ability to collect Social Security. You're only able to, this year in 2023, make just over $21,000 a year and collect Social Security prior to your full retirement age. So for most of us, it's age somewhere between age 66 and age 67. That's your full retirement age. And past that age, you can make as much money as you want, and it's not going to affect your Social Security. But prior to that age, if you take Social Security and have earned income over a certain amount, about $21,000, it's going to negatively affect how much Social Security you can collect. However, the question was, does my pension affect this? And no, it does not. Whether you take the annuity option and you're getting some ordinary income as opposed to earned income from your pension, that's not going to affect this earnings test for Social Security, nor does withdrawals from a retirement account like an IRA or a 401k in the instance if you took the lump sum. So great question, but fortunately, ordinary income does not affect your ability to collect Social Security prior to your full retirement age.
All righty, good to know. Thank you. Fourth question, can I change my mind after choosing between a lump sum pension payout and an annuity pension payout?
No, there's very few instances where you could change your mind. Once that first check comes, it's a done deal. Now, the two instances where this is not the case, so like in the case of the lump sum, let's say you took a lump sum, but then for whatever reason, now you're thinking, man, I wish I would have, I wish I had some guaranteed lifetime income, or I wish I had lifetime paychecks that the annuity would have offered. Of course, you can always use some or all of that lump sum to buy your own annuity from an insurance company, create your own pension, so to speak. So that would sort of be like changing your mind. And we've also had some clients, in fact, I had one last year who retired, took the annuity option when he retired. He had not started payments yet. He was going to wait till age 65 because the amount was going to be a lot bigger. But he got a lump sum buyout offer from AT&T. And this happens, it seems like almost every year we'll get calls from folks that receive a lump sum offer on a pension that they were otherwise expecting to take as an annuity. So there's, in some cases, the company might reach out to you after you take the annuity and offer to buy you out of your pension with a lump sum. But don't count on it. I would be pretty confident that that's the right option for you once you submit your forms. And that's something that we'll help you with as well if you're working with us, is the election process, the benefit commencement process on your pension.
Okay, let's see. Next one. How does inflation affect my annuity pension? Oh, did we already answer this one? How does inflation affect my annuity pension payout versus a lump sum pension payout?
Yeah, we kind of talked about it. Inflation, the higher inflation goes, the worse it's going to be on your annuity, because your annuity is not going to get bigger, even though cost of living is getting bigger. So that has been a big concern recently with some of the highest inflation numbers in about 40 years here in the United States. What that's going to do to the purchasing power that you have on your pension. Inflation can also affect the lump sum. Typically, when we have inflation, we see interest rates go up. And this is in part a function of our central bank, the Federal Reserve, trying to mitigate or curb inflation. They allow interest rates to go up higher, and that typically, historically, has helped inflation come back down. So inflation could be positive when it comes to the lump sum, because if interest rates are going up, we might be able to earn a higher rate of interest on our bonds, on our fixed income investments. We may, and depending on how we invest in stocks, typically value stocks have done better than growth stocks in an inflationary environment. And that's one thing that we manage and recommend to our clients, is focusing on value stocks in environments like this. That could be good for the long-term growth of the stocks if you invested in stocks with a portion of your lump sum. So it has different impacts on both options, but it does, inflation affects pretty much everybody and everything, and something that needs to be considered when building a retirement plan, so you don't run out of money because you anticipated too low of a cost of living throughout retirement.
Right. Two more. How are my retirement funds protected in the case of a lump sum payment compared to an annuity payment?
Good question. So annuity payment, we talked a little bit about PBGC earlier. It's protected by a pension benefit guarantee corporation. That means if AT&T was to go out of business and not be able to meet its liabilities, pension from retirees being one of those liabilities. And we saw this with, Sears a few years ago. We saw this in both the airline and the automotive industry not too long ago, where the company couldn't pay their pensions. So the pension benefits got picked up, or the liabilities, I should say, got picked up by PBGC. We also have seen people have a reduced pension payout in this instance where, you may have been collecting $6,000 a month from the company and that drops to $4,000 as soon as the PBGC kicks in the insurance. Certainly not something that would be ideal for somebody expecting this amount for the rest of their life to see a reduction of. Lump sum, not as many protections. Of course, if you roll this money over to an IRA or a 401k, you want to make sure that it's a good custodian that doesn't go out of business. We happen to use Charles Schwab, by the way. I don't think I mentioned that. Our clients keep their money at Schwab. We feel very confident this is a good IRA custodian for retirees, one that we're not concerned about having trouble in the future going out of business. But then furthermore, it's dependent on the security of this money is dependent on the investments you choose. You could use this money to buy a very aggressive asset class like cryptocurrency, for instance. You could buy precious metals, you could buy stocks, you could buy bonds, you can put it in money market or CDs. You have almost complete flexibility on how this money is invested, which can be a good thing and a bad thing depending on the decisions that you make with these investments. So both have their risks, of course. We've talked about many of them. And one of the reasons you probably want to at least speak with or talk to a financial advisor, if not even working with a financial advisor, regarding how to protect this money throughout retirement to give you a higher probability of success of not running out of money in retirement.
All righty. One more. What measures can I take to prevent fraud and scams when receiving a lump sum? It's an interesting one.
Yeah, it is an interesting one. Again, I would just go back to working with a financial advisor, and in particular, a group that has been around a while, probably an advisory firm that has a good track record within the AT&T community or some community that you are familiar with and can get some references about their success. Again, we use Charles Schwab as a custodian. If you started to work with an ABC company and the bank that they kept the money was the same bank as the company, that probably would be a concern of mine. Whereas a third-party custodian gives you additional protections against that company, maybe making poor decisions or, maybe even stealing the money. There's been instances like that. Many people reflect back on Bernie Madoff and the Stanford group. In this instance, those companies had they were managing the money at their own custodian. There was not a third-party custodian involved in these companies. So I'd say that's helpful. Third-party custodian and an advisory firm that has a good long track record that you can verify of producing successful results to the people that they were responsible for taking care of in retirement.
Wow, thank you. That was all of our questions for today, Tyson.
Great, thanks, Sam. Thank you, everybody, for attending our webinar series. If you have any additional questions, feel free to reach out. We hope to talk to you all very soon. Thanks again.
Thank you. Bye.